This is the beginning of part 2 of our module on market risk management and value at risk, which teaches you to identify price risk for traded positions and to use value at risk, or VAR, to quantify an entity's exposure to a specific risk factor or portfolio of risk factors that can adversely impact financial performance. We remind you that this part 2 contains 2 chapters, chapters 3 and 4, with chapter 3 describing the measurement of VAR by means of the variance-covariance approach, and chapter 4 doing the same for the historical and Monte Carlo simulation approaches. This chapter 3 describes the measurement of VAR by means of the variance-covariance approach, after providing a brief background and overview of the available choices. Our next step towards VAR estimation requires us now to contemplate 2 important matters. First, how to aggregate risk sensitivities for positions with common risk factors, and second, what shortcuts, if any, are available to determine aggregate position sensitivities to shifts in common risk factors. We therefore return to the fixed income arena and assume that the U.S. Bank has just constructed this portfolio of bonds and FRNs that you see here, and that the U.S. Bank has also constructed this portfolio of derivatives that you see here. You should readily appreciate that the risk factors for this portfolio are once again the 1-year, 2-year, 3-year, 4-year, and 5-year zero coupon rates. For our present discussion, we will work with the analytical method only, involving the estimation of modified duration and convexity. We first aggregate the cash flows for the entire portfolio by applying some of the lessons we learned earlier about the decomposition of bonds into series of zero coupon securities and the decomposition of forwards and swaps into long-short combinations of securities. From a price risk perspective, the 5-year FRN is equivalent to a 1-year zero coupon bond paying a par amount of $5 million, the principal, plus a coupon based on the most recent LIBOR reset. So 3% times 5 million, i.e. in total 5.15 million. The 3-year receive fixed FRA is equivalent to a combined short 2-year zero coupon bond paying a notional of $2 million at maturity, and long 3-year zero coupon bond paying the same notional plus a coupon of $82,000 based on the FRA fixed rate of 4.1%. So 2.082 million in total. The 5-year receive fixed swap is equivalent to a combined long 5-year bond paying a coupon equal to the 4.95% swap rate on a face value of $3 million, and short 5-year FRN paying 12-month LIBOR on a face value of $3 million. This second term is again equivalent to a 1-year zero coupon bond paying 1.03 times 3 million, i.e. 3.09 million at maturity. In this worksheet, RSFI portfolio, cells B28 to I34 aggregate from a risk perspective, the cash flows, i.e. the actual and the notional cash flows, for each component of the portfolio, including bonds, FRNs, FRAs, and swaps. The aggregate cash flows for the entire portfolio appear in cells I-30 to I-34. The next steps are identical to those from the bond example, where we will apply the analytical formulas for modified duration and convexity. The position linear sensitivities to unit shifts in risk factors appear in cells C25 to G25 right here, and the convexity factors in the cells right underneath them. We remind you now that VaR calculation consists of 5 steps. Step 1, identify the relevant risk factors. 2, evaluate the position sensitivity to adverse unit shifts in risk factors. 3, estimate the maximum expected shift in each risk factor that reflects the measurement horizon and the targeted confidence level. 4, determine the correlation between the relevant risk factors. 5, apply the assumed changes and correlations to the position in question to determine an aggregate VaR for the position. We described steps 1 and 2 in comprehensive detail in the preceding chapters of this module. We proceed now to step 3, the estimation of the maximum expected shift in each risk factor that reflects the measurement horizon and targeted confidence level. There are 3 main approaches used by practitioners for this task, each with advantages and disadvantages. The variance-covariance approach, the historical simulation approach, and finally the Monte Carlo simulation approach. Basel Capital Regulation for Market Risk recognizes each of these approaches and permits their use in the determination of market risk capital requirements for banks using their internal models, a point to which we return in Chapter 5. We describe the first of these approaches, the variance-covariance approach, in this chapter, and the other 2 in Chapter 4, in each case highlighting pros and cons. The variance-covariance approach was introduced by J.P. Morgan in the risk metrics framework. The main objective of risk metrics was to estimate VaR for the entire institution, which was defined as the maximum expected loss under normal conditions across all products and geographies over a given horizon of usually 1 day at a defined confidence level. For any position, VaR was defined to equal the fair value in currency units of the position times the sensitivity to risk factor times the potential adverse move in the risk factor. The first 2 components in this equation were discussed in the preceding chapters. Chapters 3 and 4 tackled the third component. Risk metrics next introduced the assumption that, under normal market conditions, percentage changes in prices and rates are normally distributed with a mean of 0. We remind you, in case you need a refresher, that a normal distribution has the familiar shape you see here and boasts a number of important characteristics. 1. Its shape is determined solely by its mean and standard deviation, often referred to as sigma, in reference to the Greek letter used to designate standard deviation. 2. It is symmetrical around the mean. And 3. Its height corresponding to any x value can be directly derived from its sigma by means of the following equation that we reproduce here but do not discuss further. To illustrate, the probability of outcomes below minus 1.65 sigma is 5%, and the probability of outcomes below minus 2.33 sigma is 1%. Use of the normal distribution assumption simplifies significantly the estimation of VAR. If the desired confidence level is 95%, for example, the maximum expected loss over a defined time interval will result from a change of minus 1.65 sigma, where sigma is specifically the standard deviation or volatility of the underlying variable returns over the specified interval. Similarly, for a 99% confidence level, we would use minus 2.33 sigma. The next important concept under this approach is the relationship between volatility and the square root of time. To convert yearly volatility into a daily volatility, for example, we divide the yearly volatility by the square root of 260, the number of trading days typically assumed in a full calendar year. Thus, sigma for the period is the annual sigma times the square root of t period, where t period is the length of the period expressed in years. We now apply this approach to the estimation of VAR for the individual risk factors that were identified in some of our previous examples. We begin with the euro-dollar spot position and illustrate the calculation of its VAR over 1 day at a 99% confidence level, assuming an annual volatility for euro-dollar of 15%. In cell C13, we estimate the position sensitivity to an adverse 1% shift in the position's sole risk factor, which in this instance is the euro-dollar spot, to be minus $140,000. We must now determine the worst adverse potential movement in this risk factor over 1 day at a 99% confidence level. We therefore need to translate the annual volatility input into a daily volatility. Using the square root of time relationship mentioned before, daily volatility is calculated in this cell C17 to equal 15% divided by the square root of 260, or 0.93%. Recalling now that our normal distribution assumption tells us that the worst adverse potential move at a 99% confidence level corresponds to minus 2.33 sigma, cell C18 converts this information into a worst adverse potential move of negative 2.168%. We translate this adverse move into a multiple of the unit shift in the risk factor by simple division. Finally, in cell C20, VAR is calculated simply as the worst adverse potential movement at the stated confidence interval, expressed in multiples of the unit shift, multiplied by the absolute value of the position sensitivity to a unit shift in the risk factor. Note that we use the absolute value since VAR is a loss figure by definition, so no minus sign is needed here. For our second illustration, we return on worksheet VAR FI portfolio to the fixed income portfolio analyzed in Chapter 2. To change the objective a little bit and highlight the flexibility of VAR as a measurement tool, we calculate here the portfolio VAR for each individual risk factor over a 1-month horizon, this time at a 95% confidence level rather than 99%. The result we will obtain, to reiterate an earlier point, would be a potential loss amount that is expected to be exceeded over a 1-month horizon in only 5% of instances. Assume that our risk manager has provided us with the annualized expected volatility for each risk factor appearing in these cells C29 to G29. The linear sensitivities of the portfolio to adverse unit shifts in the risk factors calculated previously are reproduced in cells C25 to G25, as are the values of the convexity factor right underneath. We need first to convert the annual volatilities into monthly volatilities. Recalling once again the square root relationship, we set monthly volatility equal to annual vol divided by, as you can see here, the square root of 12. These being bonds, swaps, FRAs, etc., with a defined maturity, a small problem arises. At the end of 1 month, the instrument's maturity will have diminished by that 1 month, which would reduce its price sensitivity. Ideally, our model should reflect this diminished remaining maturity, but we ignore this point in the interest of simplicity, and most practitioners ignore it as well. Given the normal distribution assumption, the worst adverse potential shift at at a 95% confidence level corresponds to either minus 1.65 sigma or plus 1.65 sigma, depending on the direction of the adverse move. A helpful indicator is the sign of the shift in the risk factors in cells C23 to G23. Since the sign is positive, we use plus 1.65 sigma in cell C31. Again, we translate adverse moves into multiples of unit shifts in risk factors. The shifts we used previously were plus 1 basis point in the absolute level of rates. So we first convert the percentage adverse movements obtained from the volatility input into adverse movements in the absolute levels of interest rates. And this we do by multiplying the percentage adverse movement by the current level of the risk factor, then dividing by the unit shift, as we have done here in cell C32. In contrast to the preceding example, we will need here to take into account the impact of convexity. We calculate first the linear sensitivity of the position simply by multiplying the unit shift multiple shown in this cell C32 from one moment ago by the position sensitivity to unit shifts in the risk factor. The convexity impact, however, is calculated in cell C34 by multiplying the convexity factor from cell C26 by the unit shift multiple squared. To understand why, recall that the second term in equation 4, which represents what we are calling here the convexity impact, reads as follows. While our worksheets defined and calculated the convexity factor as follows, and therefore the convexity impact equals the convexity factor times the square of the change in yield. We had intentionally defined and calculated convexity factor in the way that we did to enable us now to estimate the convexity impact in such a simple manner. Finally, and returning to our worksheet, the individual VARs relating to each risk factor are simply calculated on this row as the absolute value of the sum of the two impacts, namely the linear sensitivity impact and the convexity impact. For our final example, we revisit the FX option position, where we illustrate the calculation of the position VAR on this worksheet, VAR FX option, relating to each risk factor over a 1-week horizon at a 95% confidence level. Annual volatilities are shown again in these cells here, C23 to F23. Note in particular the 20% input in cell F23, which represents the annual volatility of euro-dollar volatility, or the vol of vol, as it is sometimes called. To emphasize again, this is the volatility of the option implied volatility. It measures how much 6-month implied vol for euro US dollar is expected to fluctuate over the next year. We now proceed in a manner identical to our previous illustrations. The position's linear sensitivities to adverse unit shifts in each risk factor appear in cells C18 to F18, and the convexity factor for euro-dollar spot, the sole risk factor to which convexity is really relevant, in this cell here, C19. Annual vols are converted into weekly vols in cells C24 to F24. Then in cells C25 to F25, we calculate the worst adverse potential shift at a 95% confidence level, set at minus 1.65 sigma or plus 1.65 sigma, depending on the direction of the shift in the particular risk factor. Again, cells C26 to F26 translate these adverse movements into multiples of unit shifts in the risk factors through simple division. For interest rates and volatilities, we translate the percentage adverse shifts into adverse shifts in absolute levels by multiplying the former by the current level of the risk factor and then dividing by the unit shift. And finally, the individual VARs relating to the two interest rates and to the vol are calculated simply as the worst adverse potential shift expressed in multiples of unit shifts multiplied by the absolute value of the position's linear sensitivity to unit shifts in risk factors. For the VAR relating to euro US dollar spot, we calculate first in cell C27 the linear sensitivity impact by multiplying the multiple from cell C26 by the position's linear sensitivity to unit shifts in the spot FX risk factor from C18. Then we calculate in cell C28 the convexity impact by multiplying the convexity factor from cell C19 by the unit shift multiple squared as before. Finally, VAR is derived simply as the absolute value of the sum of these two impacts. We could repeat this procedure for the other examples we showed previously, but we think by now you are probably comfortable enough with it to attempt it yourself. If not, please click on pause and take your time to review this material. We have thus far calculated the individual VARs relating to each risk factor, and consider now how to aggregate these numbers. Recall that our objective is to estimate aggregated VAR for the position, which is the maximum expected loss across all risk factors under normal market conditions at a targeted confidence level and over a defined time horizon. The question therefore presents itself: can we simply add individual VARs to derive the aggregate VAR that we are seeking? This would be plausible, but would imply that an adverse movement in one risk factor is inevitably accompanied by an adverse movement in all other risk factors, in each case having the same relative magnitude. Statistically speaking, this would amount to an assumption of perfect correlation among these risk factors. In other words, an assumption that the correlation coefficient between changes in any pair of risk factors equals 1. This simplistic method of estimating VAR gives rise to what is called undiversified VAR. It gives no benefit to diversification effects among the risk factors. It is true that in particularly turbulent markets, a wide range of asset classes often move in the same direction and by comparable magnitudes, suggesting a significant degree of correlation among their movements. But the assumption of a correlation of 1 misrepresents reality even in these extreme scenarios, and certainly misrepresents it in normal market conditions. True VAR will therefore lie below undiversified VAR. To derive it taking diversification benefits into account, we recall that percentage changes in risk factors were assumed to be normally distributed, with means of 0 and standard deviations equal to the appropriate volatility. From this, we estimated individual VAR relating to each risk factor as a function of that factor's volatility and the targeted confidence level of 2.33 for a 99% confidence level and of 1.65 for a 95% confidence level. We use the normal distribution assumption again for the percentage changes in the aggregated position. Percentage changes in the position value are assumed to be normally distributed, with a mean of 0 and the standard deviation equal to sigma p, the volatility of the entire position. For this, we resort to a formula commonly used in portfolio management, namely that the volatility of a portfolio of n assets is sigma p squared equals the expression that you see here, where sigma I and omega, the Greek letter that looks like a W, I, are the volatility and the weight of asset I, respectively, and where rho ij is the correlation between the returns of assets I and j. This formula can be adapted towards the estimation of diversified VaR for a position with n risk factors as follows, where VaR I is the individual VaR relating to risk factor I, and rho ij is the correlation between the percentage changes of risk factors I and j. We illustrate the application of this formula to aggregate VaR by returning, as usual, to some of the examples discussed previously. We begin with the fixed income portfolio, for which we had identified 5 risk factors: the 1-year, 2-year, 3-year, 4-year, and 5-year zero coupon rates. We illustrate the calculation of the 1-month VaR at a 95% confidence level. The aggregated undiversified VaR, VaR upper U upper D, is given by this simple formula here, while the diversified VaR, VaR upper D, is given by this more complex formula here, analogous to what we saw earlier, where VaR I is the VaR relating to the I-year zero coupon rate, and rho ij is the correlation coefficient between the percentage monthly changes in zero coupon rates of years I and j. We provide the details of these calculations in this worksheet, Aggregated VaR FI Portfolio. The first 3 tables are identical to those in worksheet VaR FI Portfolio. Note that we have hidden rows 6 to 7, 12 to 17, and 22 to 34 to preserve space. The correlation matrix provided by our risk manager for the percentage monthly changes in the zero coupon rates appears in these cells beginning here on B39. Values along the diagonal, of course, equal 100%, since these are correlation coefficients between each variable and itself. And as always, the matrix is symmetrical, since the correlation coefficient between, for example, the percentage monthly changes in zero coupon rates for tenors 1 year and 5 years equals the one between zero coupon rates for tenors 5 years and 1 year. As you should have expected, we further note that the correlation coefficients are pretty high, reflecting the tendency of interest rates to move together, especially for tenors of reasonable proximity. These would equal 1 if we assumed a parallel move in interest rates. Also, the higher the gap between tenors, the lower the correlation. The correlation coefficient, for example, between the 1-year and 5-year rate changes is understandably lower than between 1-year and 2-year changes, as you can see by comparing these two cells. The undiversified VAR is calculated in cell C36 here simply as the sum of the individual VARs. For diversified VAR, we apply equation 7 shown earlier in 2 steps, a little further down in the worksheet. First, we calculate each line of the equation at a time through a shortcut that uses the sum product function from Excel, where we multiply the elements of 2 lines, each 2 at a time, and then add the products together. For example, in cell C47 here, we calculate the first term of equation 7 as the sum product of cells C35 to G35, followed by those same cells. As required in the equation, since the squares of the individual volatilities are initially added together. In cell D47, we calculate the next term in the formula as 2 multiplied by the VAR specific to the 1-year zero coupon rate from cell C35 and multiplied by the sum product of cells D40 to G40 and cells D35 to G35, again exactly as required in the equation. And we do the same thing again all through cells E47, F47, and G47 as we advance through the successive terms of equation 7. Finally, in cell C48, diversified VAR is set equal to the square root of the sum of cell C47 to G47 in accordance with the equation. We do not find a significant difference between the diversified and the undiversified VARs due to the high correlation between the percentage changes in risk factors. For our second example, we return to the FX option, where we had previously identified 4 risk factors: euro-dollar spot, 6-month euro and dollar interest rates, and euro-dollar vol. We illustrate the calculation of the 1-week VAR at a 95% confidence level. The aggregated undiversified VAR, as before, is given by this simple formula here, while the diversified VAR is given by this formula once again. The details of the calculation are set forth in this worksheet, Aggregated VAR FX Position. The 2 tables beginning on rows 4 and 12 are identical to those from worksheet VAR FX option. We have hidden a number of rows to preserve space. Undiversified VAR is calculated in this cell C30 as before. The correlation matrix for the percentage weekly changes in risk factors provided to us by the risk manager appears in these cells here. For diversified VAR, we follow the same steps as before. Down here, we first calculate each line of the formula at a time using the sum product function again, with the results appearing in these cells C39 to F39. The diversified VAR in cell C40 is set as before equal to the square root of the sum of the 4 cells in row 39 in accordance with our equation. We observe in this case a diversified VAR that is 15% smaller from the undiversified VAR, which is due to the lower and in some cases negative correlation estimates among the weekly percentage changes in risk factors. This concludes our section on aggregated VAR. You have undoubtedly noted the importance of the volatility and correlation estimates in the calculations above. Different models are used in the market to estimate volatility and correlation, from the simple to the highly sophisticated. More advanced modules in our e-library will discuss in detail the tools and methods for the estimation of these variables. But for now we outline 3 principal techniques. The first technique simply applies the closed-end formulas for standard deviation and correlation to the percentage changes for the underlying risk factors over a specified historical period, such as the most recent 2-year or 5-year period. The second technique extracts implied volatilities and correlations from observed prices of traded instruments, such as options in the case of vol and basket instruments in the case of correlation. This technique has limited use in the absence of a liquid options market for the underlying risk factor, such as for many emerging market currencies or interest rates, and the equally limited availability of correlation products from which to derive implied correlations. The third technique uses statistical models that rely on historical data or a mix of historical and market implied data to derive the best estimate of volatility and correlation. Risk metrics, for example, uses a simplified statistical model based on historical data in which the correlation coefficient for the percentage changes for 2 risk factors I and J is determined pretty much in the normal way. Vol is calculated as the standard deviation of the daily percentage changes of the underlying risk factor over a specified period, but with different weights applying to different data in the sample. The covariance measure is calculated also in accordance with its usual formula, which is about to appear, but again with different weights applying to different data in the sample. The most recent observations for both measures have higher weights than the more distant ones, and the weights decrease exponentially with time as per the following slightly complex formulas, where sigma I is the estimate of volatility for risk factor I, RIT is the percentage change in risk factor I for day T, R with a bar on top of it is the average percentage change in risk factor I over the entire period. Uppercase T is the number of days in the entire period. And finally, the Greek letter lambda is a value between 0 and 1 called the decay factor. Risk metrics assumes 0.94 for this decay factor when daily observations are used. This factor ensures that recent observations have higher weights than the more distant ones. There is no best model to use for all situations. A useful test that we will discuss shortly involves the back testing of VAR models. This concludes our discussion of the variance-covariance approach. We next proceed in Chapter 4 to the two other approaches, beginning with the historical simulation approach and continuing with Monte Carlo simulation.